when a predominantly e-commerce first brand goes into sort of physical brick and mortar stores, right? The economics completely change.
They do, of course, because that requires a lot of investments upfront as well. And online models are typically low on initial infrastructure or whatever spends, right?
Also, you're sort of then in a race against time to ensure that your inventory gets sold before whatever things go bad.
So there is a risk of unsold inventory. There is a risk of expiry,
Right.
Especially when it comes to like beauty and personal care products, where
Correct.
there is an expiry date for things. And but the thing is, there are better margins on inventory than marketplace.
This episode of Taking Stock is brought to you by Paterson. Hello and welcome to another episode of Taking Stock. This is a weekly podcast where we pick one stock, one company and dive into it. And today we're talking about Nykaa. Right now, Nykaa has a very interesting story because we did a blog, or you did a blog a couple of years ago on Nykaa, and at the time the stock was on an absolute free fall. Right, post its IPO, the stock was going down, and in that blog, you absolutely thrashed the stock, and it sort of went down further before it turned itself around. Right. So what happened then? Like, what was going on then?
So basically it had a blockbuster IPO,
Right.
in the sense that it was oversubscribed 72 times, listing gains of 77%. Overnight, the founders sort of become a billionaire because
Right.
of the listing. But it had three key problems after that, which we can sort of make as the anchor of the podcast as well.
Right.
Number one was that they started doing a lot of physical stores.
Okay.
So while they have been historically known as
E-commerce
online
thing,
sellers, suddenly going into a physical mode was not sitting down too well, especially during that time. So now I think we're a lot more accustomed to seeing that happen with Policy Bazaar, for example, having physical stores. Lenskart has a lot of physical stores. So you're seeing a flow of the online guys getting a physical presence as well. So now I think the market is much more accustomed to that sort of a model or that sort of a shift happening. At that time when Nykaa started doing this was not what they'd signed up.
But also, I'm assuming when a predominantly e-commerce first brand goes into sort of physical brick and mortar stores, right, the economics completely change.
They do, of course, because that requires a lot of investments upfront as well. And online models are typically low on initial infrastructure or whatever spends, right? There is tech spend, but you don't have to build physical stores and buy inventory and put fulfillment centers and all of that. So what initially happened was that their financials started taking a hit. So because they were investing and expending so much amount of money, the contribution of physical stores was in low single digits at that point in time. However, the expenses were ballooning because of that. So that didn't really sit down well with investors. More so, I mean, there are two aspects to this. One is a very psychological aspect, which is, hey, I signed up for an e-commerce player. Why am I getting this physical space right now?
Right.
So this is not what I signed up for. So hence I'm going to exit the stock or not be part of it anymore, or give it flack or give it a lower valuation. The other part is, because physical stores, till they mature, do attract a certain amount of stress in terms of financials, lower profitability, etc. One of the reasons why the IPO did extremely well was because despite being an e-commerce company, Nykaa was actually profitable at that time. After that, when profitability took a hit, people were like
convinced.
They were like,
investors
felt a little cheated as well, right? Because hey, for IPOs, you're doing great in terms of finances, but as soon as the IPO is over, your finances start deteriorating for the next couple of years.
I think corporate governance or failure in corporate governance is a word used quite often with Nykaa, right?
Corporate governance, capital misallocation, blah, blah, blah was the story at that point, because naturally investors were disappointed with what they were promised or not promised, but what they were shown or showcased at that point.
Right.
And suddenly what the company turned into.
But also, so you said there were three major problems, right? So, so physical stores or sort of pivoting into physical stores from purely an e-commerce brand was one, right? So what are the others?
The other thing was that they were doing an so this can get a slightly technical shade it can get, but they were doing something known as so there are two models in e-commerce, right? One model is where you are a marketplace.
Okay.
Like an Amazon or a Flipkart, you're a marketplace.
You're sort of connecting buyers and sellers, and you're an aggregator.
So you're a platform. You've got third-party sellers on the platform, and you've got a bunch of buyers. So the platform acts as an intermediary in the middle.
Right.
The other model is an inventory model,
where you own the products. You're selling your own products.
Yeah.
Right.
So it may not be your own. It may be other parties' products as well, but you're essentially buying them first.
And then selling it at a margin.
Yeah, you're storing them and then you're selling them. So Nykaa's model is an inventory-based model.
Okay.
They don't really run a marketplace on the beauty side of things, which is a majority of their business.
Right.
So in beauty and personal care, they do own product. They procure directly from brands, and then they list it on their platform for people to buy it from. Why this matters is that there are advantages and disadvantages to both these models.
Correct.
The one primary factor is that 100% FDI, or foreign direct investment, is allowed in the marketplace model.
Okay.
So if you look at Amazon and Flipkart, they're not allowed to sell their own products. So in the marketplace model, you're not supposed to sell products in your own brand name, because you're a marketplace. You're supposed to be a fair marketplace and let other people sort of do this. In an inventory-based model, you're not allowed 100% FDI. So you can't be a foreign company really. You have to be an Indian company. However, in that model, you're allowed to own inventory.
Which makes sense, yeah.
Nykaa does that. And now why it's important is, so people would ideally say that marketplace models are better because there is less operational intensity. On the inventory model, for example, there is a high upfront investment because you're buying
it. And I'm assuming also you're sort of then in a race against time to ensure that your inventory gets sold before whatever things go bad.
So there is a risk of unsold inventory. There is a risk of expiry.
Right.
Especially when it comes to like beauty and personal care products, where there is an expiry date for things. And but the thing is, there are better margins on inventory than marketplace, because marketplace would typically fetch a 9-10% commission.
Okay.
Whereas an inventory model will have better margins because you're directly procuring from the brand and then.
But I have a question. Okay, this might be very elementary also.
Yeah.
But if I am Nykaa and I'm buying a particular product from XYZ brand, right, and then adding an extra layer of margin to it and selling it to the final customer, right? Why can't the final customer just go to that brand? Is it just distribution and access
distribution?
Okay, so that's essentially it, right? Because that product is available much cheaper to the customer. So why is the customer going through Nykaa?
Distribution.
Okay.
I mean, where will they find their own customers, right? And this may be true of, say, for example, luxury brands get access to tier 2 and tier 3 markets through Nykaa.
Correct.
D2C brands get access to the markets which they anyway don't have other than social media and paying a high commission on Amazon.
Right.
And if Nykaa is able to buy those products upfront and then sell it, why do they wait for per order?
So the smaller brand also has a guaranteed demand coming from Nykaa. Okay, fair enough. Yeah, that makes sense.
So that makes sense from the seller's perspective. And from Nykaa's perspective, why it makes sense is that they're doing beauty and personal care. And one of the largest factors in beauty and personal care, and that's a problem in India, is to do with counterfeits. So it is
to do with
counterfeits.
Oh, so like
fake products. Such an 90s word to use. So the problem is that in beauty and personal care, it is estimated by various studies that about 20% of the goods available are currently just fakes.
Okay.
So the perception is not really great, and hence what becomes very important is for people or consumers to trust the brand that they're buying from, and for them to make sure that if they're buying from Nykaa, they're getting the genuine product up their door. And it happens especially in Nykaa's case because if they're buying the inventory, quality control, and the fact that they're buying directly from the brand, hence make sure that the product is always going to be genuine.
Correct. So it's sort of giving the final consumer that sense of security also. That
And it's especially sort of sensitive a topic when it comes to beauty and personal care because you're applying these products directly on you.
Yeah.
With the objective of looking better or feeling better or getting better.
Right.
But the negative impact of it is allergies and damage and swelling and ill effects on your body.
Correct.
So that sort of the risk is very, very high compared to the reward you're actually seeking. It's the polar opposite.
True.
Hence the inventory model works beautifully when it comes to beauty and personal care. So the second problem was that people were comparing this model to Amazon and Flipkart and going, hey, why are you doing what you're doing? But the very success of Nykaa lies in the fact that they're doing an inventory model and not doing a marketplace model.
Right. We're talking about problems that they face post the IPO, right? So
yeah,
why
the perception issue was there, right?
Also, people weren't sort of convinced about this business model, even though Nykaa was pretty sure that this is the way to go, and this is what makes sense in the industry we are in, etc.
Also, there were, the model wasn't really, there is a scale sort of associated with it as well, right? I'll come to what has changed after.
Right.
But that's when you'll sort of figure why this was a problem and why it isn't anymore.
Right.
But yeah, that's the second bit. The third issue was that they entered fashion as a segment.
Right.
Because they were dominant in beauty and personal care. They currently also have about a 27% market share in online beauty and personal care sale. It was sort of intuitive for them to say, let's do fashion as well, because it's
the same customer you're targeting essentially.
Kinda.
Right.
Yeah. So they entered fashion, and now fashion has a plus point, which is that your average order values are the highest when it comes to fashion across all categories of shopping.
Right.
The frequency of buying is also high.
Right.
However, it is very, very difficult for one to make money on a sustained basis for the long term through fashion.
Correct.
That's because of a few factors. One is comparative intensity is very high. Loyalty is very low.
Correct.
Because it is very price sensitive.
Right.
Return rates are super high.
Right.
Hence, margins are lower. And then there is a whole discounting cycle, which is a function of both consumer demand, festivals, plus comparative intensity, that result in a situation where the AOVs are strong, but the path to profitability or sustained profitability is a long one.
Right.
So Nykaa had started in this business, and they were operating on the marketplace model here. Right. They're not doing an inventory model here. They're doing marketplace.
Right.
However, this obviously is a business that was running losses at that point in time. So overall, you are in a situation as a company where you're going from e-commerce to physical. You're also not convinced about the base, the customer's not entirely convinced about the base business model.
Right.
And number three, you're entering fashion as a segment, which is bleeding the company further.
Correct.
So two legs of investments impacting overall financials and reducing profitability, where profitability was the standout point of the IPO.
Right. So essentially after the IPO, and because of these three reasons, and I'm sure there's more, but majorly these three reasons, the stock was on an absolute free fall, right? From what I read over here, and might not be absolutely accurate, but it was 75% down after the IPO.
Yeah.
More than that maybe also,
the low it reached was about, I think, 75% is what it would have reached before sort of turning from there.
Okay. So I think let's get into the comeback. Story.
So the comeback has also been probably on just these 3 points, right? We'll touch the problem areas in terms of how the improvement happened. So the first one was
the physical stores.
The physical stores.
Right. Yeah.
So the narrative got flipped when people saw that the physical stores actually became profitable.
Correct. So I'm assuming it eventually broke even, right? And when whatever economies of scale kicked in, they opened enough stores for it to make sense.
Yeah.
Right.
So they have more than 250 stores now across some 80 plus cities. And the stores contribute to about a third of the total gross merchandise value or GMV of Nykaa.
Okay.
So a third of their sales are coming from physical stores, about 2/3 are coming online.
But okay, one question. These physical stores essentially were so when these physical stores were sort of set up, excuse me, when these physical stores were set up, right, they were set up from the point of view of not just sort of cannibalizing their own digital sales. I'm assuming it was set up from the point of view of appealing to a different audience, and once you set up enough stores and a newer audience sort of buys there, that's when the profits start kicking, right? I'm assuming this is why it makes sense.
One, yes, to some level, yes. But the other thing also is that, again, beauty and personal care is a market where you want to try stuff out.
Right. It's a more touch and feel.
How do you buy a perfume online without knowing you've discovered it somewhere? True. Either through a referral or you've tried it in a store.
Right.
How do you figure whether the shade of lipstick or whatever you're applying is actually matching your skin tone or
I love
not,
two
unless
men
you've tried
talking
it.
about lipstick here.
I mean, research does that. So it's a market, or it's a product where it is important to get a touch and feel of what
Right.
you're using. And as simple as, I mean, again, it's a very, I don't care much, but I use any moisturizer, right? It doesn't really matter.
Right.
But for a lot of people, it does matter in
Correct.
terms of, does it stay, does it, the lumpiness of it,
Right.
whatever, right? Whatever.
No, I
parameters
mean, you mentioned Lenskart also earlier, right? And it's very similar concept here, right? That you want to sort of try on your glasses, you want to see how you look in front of a mirror, all of those things. So I think that's where the stores and the physical aspects make sense. Fair enough.
Even online customers would probably do some guided discovery on their platform, would go to a physical store, maybe try the product out, be sure of what they're getting into, and then either order in the physical store or go back online and order wherever they're getting a better deal.
Right.
So that kind of model works beautifully when it comes to this entire thing. So that's worked for them. The evidence is in the fact that it's now profitable, and hence the market is happy. At the end of it,
Correct.
that's what shareholders care about, right?
True.
The other thing I think was also a problem earlier, or that people found as a threat back when the stock was getting thrashed, was that Tira, which is Reliance's brand, was getting aggressively into the market.
Right.
At that time, looking at how Reliance was functioning in most of the businesses, people were legitimately scared that they'll disrupt the market and eat into their share.
Correct.
That's not quite happened.
I mean, Nykaa's really a household name, where Tira, I'm assuming, isn't, right? They've got a very minuscule
but the market
share.
is also different, right? We don't really know how it works. And there's a lot of companies we analyze from a tier 2, tier 3 perspective and go like, wow, this is reality versus what our reality
that's
is.
True. That's absolutely
true. Tira is something that we'll have to look into to be able to confidently answer that.
Fair enough. And no, so again, another problem that we discussed, right, was that people weren't entirely sort of convinced about the inventory-based business model.
Yeah.
So how did that sort of turn around?
So again, the thing is, one of the things one is numbers, right? The most validation that a shareholder can get is from numbers.
Correct.
At the end of it, what we're seeing is that marketplace commissions are roughly, say, 10%, 15% tops. The contribution margins when it comes to this business, where you're doing an inventory-led model, they've steadily stayed between 22 and 24% for Nykaa, which is double. Profitability is there, and that's expanding.
Right.
So those metrics are proving very well in terms of saying that, hey, these guys are doing well on the model. But one of the other things that sort of aggravated the entire thing was that earlier they were doing this for other brands. So they would procure from other brands and then put it in their e-commerce, whatever platform.
Right.
They started their own brands as well.
Okay.
So they did a strategy where either they're creating brands or they're sort of creating brands with somebody else.
Understood.
But those are brands that are Nykaa's owned manufactured products or owned IP.
Makes sense.
Their margins are going to be even higher.
Correct.
And that used to be, say, about 10% of gross merchandise value back in 2023, 24. That is about 20% now.
Okay.
So if you look at the GMV, even the last quarter, about 3,000 odd crore of GMV was achieved purely from the brands that Nykaa,
their own in-house brands. Yeah.
So the moment the market started realizing that owned model has an advantage of selling your own brands, the inventory model has an advantage of selling your own brands on your own platform.
Right.
That wasn't utilized, or that wasn't put into action back then.
Right.
But now that it's put into action, the market has evidence that, hey, this is a beautiful model and it's working.
And again, I think this is something that all players in the industry are doing, right? Anybody who sort of works on an inventory-based model wants to then start developing their own products.
The gross margins on that business are 40 to 50%.
Right.
So what we're saying is that commissions at a marketplace are 10 to 15%. Inventory-led businesses are giving you 20, 24. And if your own brand is there, it's giving 40, you 40 to 50.
Correct.
So the vast difference.
It's a no-brainer.
Yeah. And so the projection is that given how these brands are doing, if they're able to reach about 30% in the next couple of years, this only increases the profitability from there.
Understood.
The customer is more sticky. The cost of acquisition is lower. The lifetime value is higher. So hence the benefits from a financial metric standpoint and operational metric standpoint are much greater. Now, even in this, what has happened is they initially started with probably one brand. Now they've expanded into a host of brands.
Understood.
So they've got, for example, Dot & Key is a very popular brand which they'd acquired in 2021.
Okay.
But now they own sort of majority stake in that. There is one more called K Beauty, which is sort of a collaboration with Katrina Kaif, where she owns 40% and they own the rest.
Okay.
And then they've got a bunch of other brands which they're sort of starting.
Right.
And taking the approach of what FMCG companies typically do, of saying that if my target market is different, I'll start a new brand altogether.
Understood.
So now they're able to curate brands, use their distribution and get reach automatically with a wide segment with different brands for each sort of category of customers.
Makes sense. So that, I mean, it's quite interesting, right? And I think that's probably why it works, because they already know the customer. I don't know how to put this right, but they already know exactly how demand flows. So all they've got to do is just sort of fulfill that demand by either getting another brand or acquiring another brand or whatever, right? Developing their own product or whatever it is.
I mean, that's why you end up ordering from Bistro so much now, right? I mean, because they know what you want.
They exactly know what I want.
At what price, at what time.
Okay, so the last thing that we want to talk about is fashion, right? Because I think when we were talking about the problems that they faced a few years ago, fashion and personal care, right, or beauty or whatever you want to call it, are two very different ball games, right? So how did sort of Nykaa do this comeback when it comes to fashion?
I think there was a very simple tweak that they did. Now, fashion, the problems are pretty simple, right? We listed the problems out in terms of your spillage and returns, etc., etc.
Correct.
The very easy thing to do is focus on premium, which is what they did.
Okay.
They said that, you know what, we're going to focus on brands like Gap, Guess, H&M, stuff like that, where distribution again in tier 2, tier 3 is a problem. And you can have these premium brands on the platform, focus only on that. So you're creating a certain brand perception that is better. Automatically, from a financial perspective, you're offering better unit economics.
Right.
Because as soon as the average order value increases, your delivery cost is going to remain the same irrespective of what you're transporting.
Right.
Returns, even if returns are actually lower in premium products.
Okay. I mean, why?
They have lower return rates because, I don't know, people are maybe because
people don't want to go through the hassle.
No, or if you're spending so much money, you're making a wiser decision anyway. You're not like 200 rupees ka hai to 4 manga dete, then we'll see.
So you, makes sense. Like, you know what you want. If you're spending 5,000 rupees, then you sort of know what you want, and chances of you returning are very low.
And you're not returning basis quality is bad or material is bad, etc. Because these are premium brands which are giving you greater quality in any case. So you're sort of not disappointed in a lot of these products at a lot of instances. Sizes are standardized, whatever, right? I mean,
I know. I mean, there's no real logic to it.
Yeah,
but
and you've not made a decision basis price. You've made a decision basis how it looks and how much you want it.
Correct.
And hence that decision making process itself is different.
Fair enough.
And additionally, the other thing that they're also doing in this is that they're launching their own brands here as well.
Launching their own brands here? In fashion, you mean?
In fashion, like they've done in beauty and personal care, and it's worked. They're doing that here as well, where they've got some brands like Gajra Gang and RSVP, and we've not heard of these, but of course. But as if you'll have heard of the other brands that they have in beauty.
No, but Gajra Gang is a cool name though.
Yeah. So they've got a host of like brands, and they're trying the same thing out, which if they've succeeded in their own brands on the beauty and personal care segment, it might as well sort of make sense to try it here as well, especially when the contribution margins are lower in this business. And if you can balance it out and increase margins, why not?
Correct. So when you as an expert, right, look at this from a financial angle, do you look at the beauty business and the fashion business separately?
Yes.
You do.
You've learned the art of valuation.
About time, no? I know that 20 episodes in.
No, so we do separate it out because they're inherently so different, right? They're different business models. The financials look completely different. There are different stages of evolution as well, because BPC is what started first, beauty and personal care.
Right. So what's the breakup of the two?
So if I look at the gross merchandise value, about 75-76% of it comes from beauty and personal care.
Okay.
If I look at the revenue, that is 90% of revenue.
Okay. So fashion's tiny then.
Yeah, it is. It is. It's causing big problems on valuation, but not really in terms of
Right. Yeah, because if it's just 10% of
Yeah.
revenue.
So that's how it's sort of divided at this point in time. However, they're materially different when it comes to profitability.
Okay.
So if I look at the FY25 margin, beauty and personal care would be at about 9% margin at an EBITDA level, whereas fashion was at a minus 8%.
Okay. So fair enough. Fashion's something that's new and it's bleeding money right now.
Yeah,
But that's standard, isn't it?
that's standard. But here's the thing, right? The faster it grows or the more it grows, the more the lower margin business is growing.
I don't understand.
Fashion, even at its peak, will reach low single digit EBITDA margins.
Right. Because
Whereas-
the industry is
Yeah.
such.
Whereas this one has the potential, it's already at 9%, it has the potential of going towards mid teens.
Right.
If the smaller business also grows and faster or higher, for example, the lower margin business is going to grow faster, and hence the overall margins are
Understood.
going
So
to
if
dilute.
you're an investor who's invested in Nykaa, you'd be like, just ditch the fashion business and grow this.
I mean, yeah, sure. why
Right.
not?
Because you're sort of, it's bleeding money from something that's profitable.
Yeah.
Right.
And it's okay if it's sort of it's not growing faster actually. I mean it is growing faster, but if I have to look at the long term opportunity, at least my focus as an investor would be on the beauty and personal care segment, because that is the niche, that is the space they're absolutely dominating.
Right.
The category leaders there, they have high margins, they have visibility of own brands. There are several things which are going right for them, including the stores, including own brands, which give you visibility of profit increasing from here, on top of the operating leverage that will naturally kick in into the business.
Understood.
So from my perspective, personal perspective as an investor, I would focus on the BPC or the beauty and personal care segment, and anyway that is making up a majority of the financials as well as valuations at this point in time.
Right.
It's important for me to figure out when the losses in fashion will get capped out.
Okay.
So when they'll break even basically and not bleed. It's okay for them to operate at lower margins, but they shouldn't suck money out.
Right.
That's the thing to look out for. So if I have to sort of also look at the last quarter, the second quarter FY26 margins, the fashion margins were at a minus 3%, minus 3 or minus 4, minus 3.5.
Right.
So they've sort of significantly narrowed their losses.
Yeah, so it is going towards that break-even thing, right? From 7 to then 4 to now 3.5.
So from that 75 or whatever percent that the stock lost from its IPO, it's already doubled from that low. So it's already sort of factoring in a lot of the things that we're speaking about in terms of profitability going back, increasing, previous problems getting resolved, and all of that. So that's sort of already starting to reflect.
Okay, now let's talk about valuation.
So I mean, again, as you rightly pointed out, we'll break it down into two parts. You'll look at beauty separately and fashion separately. Beauty would get like a much higher multiple. It can also be valued basis and EV EBITDA on a forward basis, because it is EBITDA positive, and EBITDA is also sort of getting normalized over time.
Okay.
So if I have to just give a very broad perspective and look at the past financials, how much the industry is growing. So let's put it this way: FY25 or 26 to FY30, how much can the company grow at? If I have to very simply put it, the beauty and personal care market itself is growing at about 12%. Within that, the premium market is growing at 13 to 14%.
Right.
Furthermore, the online market is growing at 2x the size of that.
Correct.
So these guys, they've achieved about a 36% growth in GMV over the last 5 years, CAGR.
Right.
You can expect it based on the numbers I just highlighted, about medium double digits, medium 20s, they can easily sort of pull off. If you have to assume that and a higher EBITDA growth, you will reach higher profitability on an FY28 basis, and then give it a multiple. A lot of brokers, and I find it comfortable to give it like a 50 times multiple on a FY28 basis.
Okay.
50 times, I mean, it's gonna get a little like, is it low, is it high? You don't get a sense of that. So just to give a little bit of a background there, if I have to look at some of the global fashion players, there's a Honasa which is at 27 times. Basically, they're trading between, say, 15 and 25 to 30 times.
Okay.
Whereas we're ascribing a 50 times multiple. That's also because India as a market is much more high growth compared to these.
Right.
And secondly, these guys are absolute market leaders in their space. And third, because own brands. So that
Understood.
gives you the stickiness and the better
premium,
financials compared to the others. If I have to sort of compare it with the other listed players, India's currently Eternal's at 40, Swiggy's at 100, Cartrade's at 30, Policy Bazaar is at 40. So it's not completely out of whack to say that
Right, 50 is sort of within that.
Given the model, given how the space is. So that would be one part. The second part is, but obviously valuations and multiples depend on personal factors and whatever, right? It is a judgment game.
Right.
So I'm just quoting 50 times as someone, a lot of brokers have given it. Now it's upon oneself to figure whether
are you comfortable with it or not? Yeah.
So at a 50 times multiple, one of the recent Motilal Oswal reports, for example, came to a valuation of about 73,000 crores on the beauty and personal care business, which translates to about 255 rupees per share.
Okay.
Roughly the stock is trading around that.
Around that right now, yeah.
And then on top of that, you want to add or ascribe some valuation to the fashion business.
Okay.
Fashion business, because it's not profitable right now, typically the way to go about it would be do a DCF over the next 10 years and figure a value for it. Motilal Oswal's report again came to a value of 30 rupees per share.
Which is fair right now.
I mean, that's what they came to. So it comes to the total value, comes to fair value, according to Motilal Oswal, comes to about $280.
Right.
And that's how you'd actually typically value it. But from a long-term basis, valuation aside, if I have to take a very sort of crude look at what's happening, I think there is clearly a very large opportunity because the segment is very fast growing and Nykaa is the undisputed leader in that segment.
Right.
However, there is a sort of legitimate threat coming up as well, which needs to be sort of at least be taken into cognizance. Or people need to sort of at least speak about.
But what is that threat?
Quick commerce.
Okay.
So the quick commerce threat is that beauty and personal care as a segment is a dominant driver of non-grocery sales in e-commerce, quick commerce.
Understood. So you're saying the quick commerce first brands could then start cannibalizing Nykaa's sales.
So Nykaa's launched something known as Nykaa Now, which delivers in 7 minutes and blah, blah. But again,
I don't think you can say that anymore, by the way.
What?
7 minutes, 10 minutes.
That's for people who order, na? It's on their conscience, not on mine. I'm not ordering Nykaa.
The governments come up with, companies can't claim 10-minute delivery, 7-minute delivery. You can't claim a minute or a number to it.
Okay,
you can say quick. You can say quick delivery. I mean, the category is called quick commerce, but yes, you can't say that anymore.
They used to do 7 minutes. Now we don't know.
Yeah. But I saw Myntra also sort of trying to get into this quick commerce space where you can literally order a shirt and it'll come to you within the next 30 minutes.
Yeah, I mean, shirt is still okay. My point is that if my skin feels dry, I need a moisturizer. I need it right now. I'm not, going online.
And you call me privileged.
Bro, I mean, come on.
How did we live before quick commerce? No? Feels like the Stone Age.
Nothing. Call a store and get it. No.
Yeah, that's true. But I mean, so I'm assuming for Nykaa to build their own quick commerce setup, right? It's too complicated, too difficult, too many factors.
No, but they've got those 280 plus stores in 80 cities, no?
Okay, so you use that as your...
I mean, proximity and all, I don't know. But if you compare it to so there is a Nykaa store very close to my house.
Okay.
If I ever feel like ordering something from Nykaa, I'm sure to get it fast because it's right across the corner.
Correct, but yeah, I understand.
But it's not about me.
No, but I understand the concept of the fact that beauty and personal care would be big, will have high demand in quick commerce because these seem products that are something that I need. It's a very impulse buy also.
Yeah.
Right. In a lot of stores also, these are, right next to the checkout counter is where a lot of these products are usually kept. So I understand that. Do you really think it's a legitimate threat though?
See, I mean, I'm saying if the industry is growing at 35%, not 35, 25%, Nykaa is the leader in that space. I mean, my usual point of view is that if something is growing really fast, the tailwind will take you along.
Correct.
So, I mean, there may be, my threat is only to the 50 times multiple. Then it doesn't deserve that 50 if it comes under threat. If growth rates come under threat or market share comes under threat, then that 50 will come to 25 and that reduces the value by half.
Correct.
So that's the threat I'm just sort of saying
sense, yeah.
is legitimate from a valuation perspective, not maybe from a business perspective or whatever, right?
Correct. Cool. I think we're done. No, we're just faffing around now. Okay. So thanks a lot, guys. Thanks again for listening. I think this is it. If you have any further questions about Nykaa or the valuations, please put them down in the comments. We release new episodes every week, so please watch. Let us know which companies you'd like us to cover, and like, share, subscribe, all of that. Thank you.
Disclaimer. This content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.